There is something strange about money. It is the thing that nearly every human being on earth thinks about every single day, and yet almost nobody truly understands how it affects the way they think, feel, and make decisions. Tonight, we are going to explore the psychology of money, not how to pick stocks, not how to read a balance sheet, but how your own mind works when money is involved, and why understanding this is worth more than any financial advice you have ever received. Make yourself comfortable. This is a story about you. Let us start with a simple question. Why do people who earn a lot of money sometimes end up broke? The answer is not what you might expect. It has almost nothing to do with intelligence. Some of the smartest people in the world have gone bankrupt, and some of the wealthiest people you will ever meet never went to college. The reason is that financial success is not about what you know, it is about how you behave, and behavior is incredibly hard to teach. A genius who cannot control their spending will always be poorer than a factory worker who saves 10% of every paycheck. Always, without exception. This is the first lesson of the psychology of money. Your behavior matters more than your knowledge. Let us talk about something called the hedonic treadmill. It is one of the most important concepts in all of psychology, and almost nobody has heard of it. Here is how it works. You get a raise at work, you feel wonderful, you celebrate, maybe buy something nice, and for a few weeks life feels better. But then something happens, you get used to the new income, it becomes normal, the excitement fades, and now you need another raise to feel that same rush again. This is the hedonic treadmill. No matter how much more you earn, your expectations rise to match. You are running on a treadmill, moving your legs faster and faster, but never actually getting anywhere. A person who earns $50,000 a year and spends $40,000 is wealthier in every meaningful sense than a person who earns $500,000 and spends $510,000. The first person has freedom, options, peace of mind. The second person has stress, debt, and a lifestyle that depends on everything going perfectly forever. Wealth is not what you earn, wealth is what you do not spend. Now let us talk about fear, because fear is the most powerful force in all of finance, more powerful than greed, more powerful than logic, more powerful than any spreadsheet or analysis. When the stock market drops by 30%, something happens in your brain that you cannot control. Your amygdala, the ancient part of your brain designed to keep you alive on the savannah, activates. Cortisol floods your system. Your heart rate increases. Your palms sweat. Your brain is screaming at you. Danger. Run. Sell everything. Protect yourself. And in that moment, every piece of financial advice you have ever read vanishes. Every chart, every statistic, every historical example of markets recovering, gone, replaced by pure, primal fear. This is why markets crash, not because of economic fundamentals, not because companies suddenly become worthless, but because millions of human brains, all wired the same way, all experience the same fear at the same time, and they all press the sell button together. The people who get rich in crashes are not smarter, they are not braver, they have simply learned to recognize that feeling of panic for what it is, a survival instinct that is catastrophically wrong in the context of financial markets. Let us talk about compounding. Albert Einstein supposedly called it the eighth wonder of the world. Whether or not he actually said that, the point stands. Compounding is simple in theory. Your money earns a return. Then that return earns a return. Then that return earns a return. Over time, the growth becomes enormous. Here is an example that most people find shocking. If you invest $1,000 at 10% per year, after 10 years, you have about $2,600. Not bad. After 20 years, you have about $6,700. Getting better. After 30 years, you have about $17,400. Impressive. After 50 years, you have $117,000 from a single $1,000 investment. But here is the truly remarkable part. More than half of that total came in the last 10 years. The first 40 years produced about $45,000. The last 10 years alone produced more than 70,000. This is why patience is the most important quality in investing. Not intelligence, not timing, patience. Warren Buffett is worth roughly $100 billion, but 99% of that wealth came after his 65th birthday. Not because he suddenly became a better investor in his 60s, but because he started investing when he was 11 years old and he never stopped. The real secret to Warren Buffett's wealth is not skill, it is time. There is a concept in psychology called loss aversion. It was discovered by Daniel Kahneman and Amos Tversky, and it fundamentally changed how we understand human decision-making. Here is the basic idea. Losing $100 feels about twice as painful as gaining $100 feels good. The pain of loss is roughly double the pleasure of an equivalent gain. Think about what this means for investing. When your portfolio goes up by 10%, it feels nice. When it goes down by 10%, it feels devastating.